Welcome to First Mover, your first global look at today's action in the Bitcoin, blockchain, and digital asset space. I'm your host, Christine Lee, and joining me are my co-hosts, CoinDesk Managing Editor of Global Capital Markets, Lewitinn, and Managing Director of International Content, Emily Parker. Good morning, Emily and Lawrence. Happy Friday.
Happy Friday.
Let's take a quick look at Bitcoin. The CoinDesk Bitcoin price XBX index currently trading at $38,799, down about 2.2% over the past 24 hours as those options contracts expire at the end of the month. And the CoinDesk Ether price ETX index is at 23.37. ETH slightly up, almost 2% for the day. And the new DFX CoinDesk DeFi index is trading at about $500. DeFi is up about 0.7%. The most reliable reference prices for institutions since 2014 are now published under the CoinDesk brand, trusted globally as the leader in crypto and data. All right, so looking at one of our top stories, Robinhood was a big flop, falling 8% in its trading debut. They had priced their public offering at $38 per share and ended the day at $34. So it's pretty disappointing. Emily, especially after the whole meme coin or meme stock phenomenon.
Yeah, it's super interesting. So you can never really judge the success of a company based on its IPO, but there are a few interesting things to note here. First, the comparison to Coinbase's IPO, which was like, the news event of the century, at least in crypto world. And, also this kind of idea of where Robinhood fits into this whole sort of like retail investor meme coin revolution. So, the question is does the IPO's performance say something about that? I mean, one of the interesting things about Robinhood, just from the crypto perspective, is that they kind of had a first mover advantage on Dogecoin. They listed Doge before Coinbase did. And I think that was, that made them play a kind of a big role in the crypto economy. And then, I don't know if that has anything to do with it or just the fact that the crypto market is down. But anyway, it's interesting.
I think that's just that was just kind of like one little point of interest. But in terms of like, oh, it's a novelty. That's great. You could trade your Doge on it. But at the end of the day, people, customers and everything, they looked at this and they said, okay, you know what? We're getting free trades, but what they say is that if you get something for free, chances are you're the product that's being sold, and that is indeed what's the story here with Robinhood. Is that 80% of their revenues came from pay for order flow, and I think people are looking at this and they're saying, well, you know what? That's kind of like not a great business model if, let's say, Congress bans it or something should happen, and it also had this reputational issue with retail customers. And I think that's kind of bleeding into the IPO itself, where people are like, oh yeah, Robinhood, we know it's easy to use, but we know there are problems. I can't sell my stocks when I want to. I can't get in on the hot new stocks.
Apparently Reddit was celebrating the bad IPO. I don't know. So I think
they celebrate everything. I mean,
I think it's not as bad as Coinbase,
to be sure.
IPO'd. It made every crypto company and those crypto adjacent companies think about maybe what are my options with regard to raising money and going public. And so Robinhood certainly took its turn, and nevertheless, they were still able to generate over $2 billion in proceeds from these shares. So regardless, the company is now well capitalized and will achieve its goals.
And
the IPO that everyone
timing on its side too, there's also the question of what if, Coinbase had IPO'd now and Robinhood had IPO'd then. I mean, a lot of this is based on the headwinds of the market. So
yeah, the timing of Coinbase's IPO was great because it was the top of the market of Bitcoin. But the other thing too is Facebook is the other company people compare it to. Facebook had a bad IPO, and obviously it did much better since. But there are other things involved with Robinhood that you can't compare it to Facebook necessarily.
Time will tell. And in other news, some big regulation, or rather some legislation coming through the House that has been introduced. And that's where our CoinDesk Global Policy and Regulation Managing Editor, Nick Day, comes into play, who's also the editor of CoinDesk, the State of Crypto newsletter. Hello there, Nick. So the U.S. House has a new infrastructure bill that enhances reporting requirements in the crypto industry, and you're working on an in-depth analysis. What have you uncovered?
Yeah, so there's actually two bills that we're paying attention to right now. First is the infrastructure bill that, as you mentioned, is sitting before lawmakers. That's actually in the U.S. Senate. It was so far, sort of introduced. We haven't seen the full text of it, and we talked a little bit about this yesterday. But later yesterday, U.S. Representative Don Beyer out of Virginia introduced a pretty massive bill that would add a whole lot of clear definitions and provide some jurisdiction and oversight to the digital asset sector. Seemingly answering a lot of questions and requests from the industry about this regulatory clarity that we've spoken about a couple times already, this year. But this bill has quite a bit that I think the crypto industry will love, a little bit that I think that they're going to be questioning, and some stuff that probably could be fleshed out a bit more. But it would, if passed, basically define what cryptocurrencies are securities, what are commodities, who has jurisdiction over what, how can a security become not a security, which is basically the big thing for ICOs. It would direct agencies to create some clear guidance around DeFi and taxes, and evaluate what's happening with these industries. So it's pretty massive. It would it would answer a whole lot of questions at once if it's passed.
Nick, what do you think is the likelihood of it being passed?
To be honest, I have no idea. I did not see this bill coming. I don't think no one I've spoken to so far has seen it coming. So, it almost came out of nowhere. But at the same time, it's clearly one that a lot of work has been put into it. It is 58 pages. It has 5 sections that address various laws governing the SEC, the CFTC. I counted at least 8 federal agencies that have a role in this. So, I think we're going to hear that more information about how it came together in the days to come.
Yeah. So what exactly happened? Because wasn't there another bill, the taxonomy legislation that they were trying to get through, and you had a whole bunch of Congress members on that, and now all of a sudden this other thing comes in. Like, what's going on here? It sounds like there are 2 different things happening in the House at the same time, and that taxonomy bill seems to be lagging and it doesn't seem to be going anywhere. What makes Beyer think this is going to go anywhere? And one more thing, stablecoins. He threw it in there.
Yes. Sorry, I completely mentioned. Yeah, I should have mentioned that. Let's talk stablecoins first. So the most striking thing, and this is the part I think the crypto industry will have the biggest issue with, is this bill would allow the Treasury Department to basically say yes or no to a stablecoin. It will give the department the ability to approve or authorize a private stablecoin to be operational, or at their discretion, the Treasury Department could say, no, we don't like the stablecoin. And it doesn't grandfather in any existing stablecoin. So presumably this would apply to things like USDC and Paxos, the Paxos dollar, which have been floating around for years. So that's pretty significant. It would have, Tether? I think, a huge impact.
Is it targeting Tether? I mean, is that kind of
you could?
Is that what you picked up?
I don't know if you could say it's targeting Tether. It's pretty broad, but Tether would almost certainly be caught up in it. The bill would restrict even the use of a stablecoin. So my question is, are exchanges going to have to delist if this bill is passed until they get clarity from the Treasury Department? And my initial instinct is yes, that might actually be the case.
Let's get back to the. Well, let's get back to the. I'm sorry, we'll get back to the other question first, though. Again, which is you had the taxonomy legislation, and then now you have this one. It seems like there are 2 competing legislations, correct? Pieces of 2 competing bills. Which what's going on here? Like, this even has a chance while that other one doesn't? That doesn't seem to make sense. Oh boy!
Oh, I think we've got a frozen image
internet.
Of Nick. All right. Well, Nick will be, Nick broke the internet. All right, we'll get back with Nick when he's able to come back. But thank you very much, Nick. That was CoinDesk Managing Editor of Global Policy and Regulation, Nick Day. Don't forget to sign up for the State of Crypto newsletter on CoinDesk.com. All right, so while the House debates regulation of digital currencies, the SEC and Financial Stability Oversight Council are being prodded by Senator Elizabeth Warren on what role, if any, they play in regulating crypto. Joining us now to discuss is attorney and former SEC branch chief, Lisa Braganca. Welcome to the show, Lisa. So as Nick was saying, this new House bill has some stringent reporting requirements for folks in the crypto industry. It also mentions stable coins and how those should be regulated. But I wonder, should Congress be playing a role in this?
Well, I think it is an appropriate role for Congress to play. And one of the things that I'm particularly excited about in having Congress look into this is clearing up the overall confusion that we have. While we have confusion in the crypto area, that's not the only place in money transfer and in securities and in derivatives. We have a commodities regulation. I mean, it's a mess. So I think crypto has just surfaced the problems that we have in our current regulatory system. And if Congress is going to intervene, I think it's great to think about maybe a more holistic, simple approach rather than the Beyer legislation, which tries to fit crypto and regulation of crypto into the current regulatory alphabet soup that we have. This might be an opportunity to create a singular kind of regulatory system for crypto, and maybe the rest of securities and commodities, and we can move more into a unified regulatory system, because it is just loopy that for crypto participants, but for other participants too, to have to figure out how to comply with the CFTC regulations and the state regulations and the SEC and the Federal Reserve and the FDIC and the whole alphabet soup. So I see it as an opportunity, but maybe I'm reaching for pie in the sky here.
The Beyer piece, that the legislation that was proposed, it's as I was asking Nick, unfortunately he got frozen out while we were asking, but how does it compare with the other one that Congress has been mulling for a while with, you had several legislators on that one and people working very hard on trying to get that through Congress, and it's just kind of been sitting there, and Beyer just comes up with this all of a sudden, or Beyer just shows up with this. What exactly, which one has a better chance? Which one seems more reasonable? And which one has, just politically, which one has more likelihood to happen?
Well, I haven't looked at the last one in a while, so and I'm not really familiar with what's holding it up. But I will say that it's generally better to have multiple sponsors, so that makes the initial bill that's pending, a stronger one than the Beyer bill. But it could be that this second one was proposed because of holdups in the first one. So I think it's an opportunity for us to take a look at both of those, put them side by side, and then figure out what were the log jams, what was it that was really holding up the first bill, and can we address that and get more sponsors onto the second bill? We need, bipartisan sponsorship, really.
Are you getting the sense that stablecoins are one of the big threats to regulators, and that's kind of why we're starting to see all this legislative activity?
I'm not sure that it's stablecoins. I think that's it is something that draws their attention, but I think this is more a result of the new administration. We have, a little bit of a chance to take our eye off of COVID for a few minutes, and get back to crypto. And also the, Gary Gensler. We have a very knowledgeable person in the SEC who comes from the CFTC. What a great time to address the problems of multiple agencies with, sometimes conflicting, but oftentimes just, additional regulatory requirements for participants in the market.
Lisa, welcome back. While we're talking about stablecoins, this has been a really hot topic in crypto lately, and you definitely have some people, warning of these risks of stablecoins not being backed properly or not being transparent enough, and how this could potentially just crash the financial system. And I'm just curious what your personal take is on the stablecoin issue. I mean, is this something that we should really be worried about, and if so, what should regulators do about it?
Well, stablecoins, I think could may be overselling themselves. I mean, they're only as good as the reserves that back them up. They aren't like a government where, the US dollar was backed by gold until 1971, and then it wasn't. But the US dollar is backed by the ability of the US government to be able to impose taxes and be able to pay people. So here, a stable coin is just like, in my mind, in this realm, like a money market. And, we broke the buck a while back when people could not get their money out of money market funds, back in 2008. So I do believe it's important to have transparency and to have solid reserves. So it isn't just, can you see what's going on, but do the regulators believe that it is stable enough for the industry? I mean, the various financial regulators are responsible, as we saw back in 2008, for making sure that the whole system doesn't melt down. And, hypothetically, if we all fell in love with stablecoins and we all moved our money out of money markets and we put them into stablecoins, that could become a real weakness in the marketplace. It could become systemically, important, and that means then that the government really should be looking into that. I mean, we have times where
Lisa, just really quickly, are stablecoin securities, and should the composition of the assets backing them be public information?
It depends on what the assets are backing them. So, if the assets were gold,
well, for example, Tether, commercial paper, and
right,
we don't know which corporations are involved in that.
Right. It really does depend. And again, we have this problem of the rules will be applied, on a case-by-case basis. We will have to look at every one of them to see. And I really do hope that what comes out of this legislation is more pressure for the SEC and other regulators to offer really more specific guidance. And I think, just going back, we haven't mentioned the Ripple case, but that's just an example of what happens when the government doesn't offer clear guidance and sort of lets, an issuer go on and on and on for a while, and then suddenly decides, oh, wait, no, we were just kidding when we ignored you all those years.
Lisa, real quick, sort of switching gears here. I'm curious about your take on Robinhood. You've weighed in on this in the past. What do you think of what happened with the IPO, and what's the significance of it?
I have to say, I'm not a fan of Robinhood. I am kind of happy that the market did not love it. I think that its business model of making the investors or traders or customers the commodity that's being sold is not a great one. I'm not a fan of free. I think that just misleads people, and it hangs into a part of our brain that we as human beings we fall in love with free, and we will do dumb things in order to take advantage of free. So, not a fan. I don't. I think that the fact that it did not do that well, I don't know if it relates at all to the FINRA investigative letter and looking into the principles of the holding company not being registered with FINRA. But, that seems like a no-brainer. I don't understand why anybody who's controlling a broker-dealer
certainly could have had a chilling effect on the IPO. We got to wrap it there, Lisa, but thank you so much for joining us. Appreciate your insights. That was attorney and former SEC branch chief Lisa Braganca. Coming up, checking in on Asia and a crypto markets update with automated investment crypto advisor Makara. Now for the daily forecast and update on what's happening in the Asia crypto markets. Here's Angie Lau of Forecast News.
Welcome to the Daily Forecast, July 30th, 2021. I'm Angie Lau, Editor-in-Chief of Forecast News, covering all things blockchain. Coming up, the Korean city of Busan plans a digital asset exchange. Bitcoin mining difficulty is increasing, and China's Tencent launches a digital IOU platform. Let's get you up to speed from Asia to the world. First up, as South Korea gets set to tighten restrictions on crypto exchanges, one city is acting as a regulatory safe haven and getting ready to start its own digital asset exchange. Busan City is reportedly set to spend almost $40 million on the project. The city was designated as Korea's regulation-free blockchain zone last year, meaning blockchain developers can bring proposals to the city government that are blocked by regulations elsewhere. But will it be a success? Well, one expert told Forecast News there are many hurdles to clear first.
첫 번째, 업체가 일단 조금 진취적인 그런 사업 모델들을 제시할 필요가 있어요. 그게 일단 첫 번째고요. 그렇게 제시가 되면 부산시 외에 이제 관계부처들, 정부 관계부처들이 그래, 이건 좀 해보자. 이거는 우리가 규제자의 특구 샌드박스 취지에 맞으니까 좀 적극적으로 밀어주자. 이렇게 좀 전향적인 검토를 할 필요가 있습니다.
A city official told Forecast News that Busan is in the early stages of making specific plans and policies for the new venture. Meanwhile, Bitcoin miners who quit China following the clampdown appear to be wasting no time getting back into the game. How do we know? Well, the mining hash rate is back on the rise, having plummeted following China's clampdown on crypto mining in the country. It's been climbing again since early July. According to data from BTC.com, that means the difficulty level calculation set to be made this weekend is predicted to increase by almost 5% after having dropped to its lowest level in 18 months at the last reading. When the hash rate increases, Bitcoin mining difficulty also increases. The difficulty level is calculated every 2016 blocks, which works out at roughly once every 2 weeks. And that difficulty refers to how hard it is for a miner to dig for Bitcoin, and that depends, of course, on the global hash rate. With those Chinese miners making their way back online overseas, it means competition is heating up again. But on the final trading day of the Asian trading week, it looks like it's still lukewarm for Bitcoin, down almost 0.5%, still sitting just under that $40,000 mark. That's as of 4 p.m. Hong Kong time today. And this follows the broader Asia market in the red today, with a lackluster debut by Robinhood on NASDAQ, closing 8% down on its debut price of $38. One analyst told Forecast News that was due to inside selling.
So I think really because of its unique customer base, this young retail investor base, it was really based upon a model has exploded, right, because of the pandemic, but also consists a lot out of speculation, right? And almost 40% of their trading volumes is just options, right? And people just being very active trading there.
Ben Emmons says it was a case of quick profit taking. And in the top 10 for cryptocurrencies, XRP rebounded up almost 6% today, and Ethereum up 4.5% ahead of its EIP 1559 upgrade next week. And finally, not got enough cash on hand and you want to borrow from a friend? Not to worry, a Chinese tech giant may have the solution. Tencent has added a digital IOU platform backed by blockchain technology to its WeChat app. Called Mini IOU, it provides users with e-signing services for personal loan contracts. Simply fill in your names, loan amount, time period, and interest rate, and it will generate an IOU note that can be sent via WeChat to your friend. Once both sides approve, the IOU is stored on Tencent's Xixin chain. Using blockchain this way could ensure the authenticity of a debt and offer crucial evidence if any conflicts arise between friends. In fact, Xixin chain, which launched in 2019, has already been used in court for copyright dispute trials. The IOU has one other function too. It can chase your loan, so you don't have to feel awkward about asking your friend to pay you back. And that's the daily forecast from our vantage point right here in Asia. For more, visit forecast.news. I'm Editor-in-Chief Angie Lau. Until the next time.
The Crypto Markets Update is presented by Grayscale, the world's largest digital currency asset manager.
Let's have a live look at Bitcoin. The CoinDesk Bitcoin price XVX index is currently trading at 38,821. Bitcoin pulling back ever so slightly, almost 3% over the past 24 hours. And the CoinDesk Ether price ETX index is at 2338. ETH is advancing 1.9% over the past 24 hours. And the new DFX CoinDesk DeFi index is at 498. DeFi also getting forward about 26 basis points over the past 24 hours. Joining us now to discuss the crypto markets is Jesse Proudman, CEO of Makara, an automated investment crypto advisor. Welcome to the show, Jesse. So we saw a rally in Bitcoin triggered by the short squeeze of Bitcoin. Now BTC is pulling back slightly as monthly options contracts expire. So where does Bitcoin go from here?
Yeah, it's a great question. Thanks for having me, Christine. Pleasure to be here. I think this is a market that ebbs and flows with sentiment, and we saw 6 months of incredibly bullish sentiment at the start of the year. Obviously, sort of the narrative around ESG popped that sentiment, and we saw a pretty big pullback over May and June. That doesn't last forever. So these ebb and flow, and over the last week, we've seen interest and really a set of news stories driving focus back on the broader industry, and that focus brings traders, and those traders bring purchasing power. So we think we're on our side at the beginning of another leg up within these markets. Sort of how long that lasts is anybody's guess.
Jesse, I saw your notes about ESG having what you said was a chilling effect on corporate balance sheet, and my gut, or at least the way I see it, is that it's probably not that. Could it be that also that just people are applying that excuse as to why they're not buying Bitcoin? In other words, they're saying, you know what? Oh, the price is down something. Oh, I don't know. Maybe we shouldn't be buying it. After all, Bitcoin is just a big polluter anyway. Isn't that more the likely scenario than companies saying, oh, gee, we don't want this asset that will quadruple in price over the next few months on our balance sheet because of some pollution, potentially coming out of miners. In other words, are you applying this whole ESG argument to something where it's really more about price movement?
Yeah, I mean, at the end of the day, this entire industry is about price movement, and narratives get assigned after the fact. I believe that the broader rally that we saw at the beginning of this year really was a function of external interest driven by that corporate balance sheet activity. Certainly that is a function that balance sheet purchasing, that's a pretty radical departure from traditional treasury management. And so with sort of this group of companies that we saw adapt those strategies, that leads the news cycle. But at the end of the day, that wasn't a broad-based adoption. We didn't see that go beyond sort of a handful of companies. And then certainly that ESG story, it gives somebody a narrative to talk about why that stops. I think there's value there to that narrative that at the end of the day, people were concerned. And we saw that at Makara, given the type of questions we were receiving from our clients. So it's not as if it's sort of an irrelevant question, but I think you're right. It's not the sole reason that ceased sort of the broader adoption of Bitcoin as a treasury asset.
How much of the current narrative do you think is attributed to this sort of like institutions, jumping on board, or like the complete opposite, which is the sort of like DeFi anti-authoritarian, trend that is pushing up the prices of cryptocurrencies?
Yeah, it's interesting. The 2017-2018 cycle, that was a predominantly retail-driven cycle, and the narrative, sort of the drumbeat that entire time was the institutions are coming and the institutional capital. Certainly over 2018-2019, the drumbeat was the institutional capital will save this industry. From an infrastructure perspective, this entire asset class wasn't ready then to support that institutional wave, and we're finally now in 2020 and 2021 ready and able to support those new market participants. And so now it's time to move the narrative on to the next topic. Certainly, the DeFi narrative around sort of opening up this trading infrastructure or creating a infrastructure that is sort of outside the bounds of regulatory authority, that becomes a very popular narrative, particularly as we've seen sort of this increase in regulatory crackdown across the established sort of more centralized players. So I think that the story itself holds weight. But at the end of the day, I think the majority of the trading happening in this industry, it's happening on centralized platforms, and it will continue to happen on centralized platforms for time to come.
Jesse, you mentioned Bitcoin may head for another leg up. So just want to gauge your outlook on the second half of the year.
I think summer is always sort of a lull in this industry, particularly this summer with sort of post-COVID. Everybody is out sort of living their life, and thinking about your portfolio or where you're deploying into alternative assets is not high on people's mind at the moment. Our belief is that sort of as people come back and we get back into the grind of fall, that consideration is back on people's forefront. And really, one of the biggest things we're seeing now is an increase in regulatory clarity. This transition and particularly the crackdown on Binance and the shift in FTX's margin products to reduce leverage. All of these things, while on the surface seem to be sort of negative characteristics of the space, at the end of the day, we really believe they're positive components that driving legitimacy, driving regulatory clarity, driving a reduction in raw speculation as a function of gross leverage capability. All of that is a net positive for the industry. And so that, timed with people coming back from summer, really, I think, sets the stage for an exciting back half of the year.
All right, price target for the end of the year.
It's impossible for me to make price targets. That's the fun about this industry. I think we're going up.
Right.
I don't know how far we're going.
Thank you, Jesse. Appreciate your time.
Appreciate
that was Makara
CEO
CEO Jesse Proudman. Coming up, how the U.S. stacks up on the global central bank digital currencies race.
CoinDesk indexes, the market standard for crypto assets since 2014. The CoinDesk DeFi Index is our latest product and provides insight and exposure into decentralized finance. Our indexes are key for investors looking to access and understand crypto markets.
The CoinDesk DeFi Index is the best tool for a diversified approach to this compelling new category of digital assets.
The CoinDesk DeFi Index, measuring the investable DeFi market.
All right, the United States is falling behind on central bank digital currency development, according to the Atlantic Council. The U.S. think tank has launched a new CBDC tracker, database, and interactive toolkit as the number of countries exploring CBDCs has exploded, more than doubling to 81 countries over the past year. Joining us now is Atlantic Council Senior Fellow Julia Friedlander, who has also testified before Congress this week on CBDCs. Welcome to the show, Julia. So in your testimony, you said of the countries exploring CBDC development, the United States is furthest behind in its work on digital currencies. So why is that the case, and what are the consequences of falling behind?
Thank you so much for having me today. And it's really a pleasure to be able to share the painstaking work that my team has produced over the past couple of months on the CBDC tracker, culminating, as you mentioned, in our testimony earlier this week in the House of Representatives. To answer your question, to start off, I think it's because, the U.S., given its global role as financial standard setter, has to be rather cautious in how it deploys a CBDC. This isn't a small niche market, managing a small currency that is not interchangeable around the world. In fact, it's quite the opposite. So I think the caution reflects, Chairman Powell's feeling, first of all, that, you have to be careful with how you deploy the global reserve currency in new form and fashion. And also there are questions about whether the Federal Reserve Act allows him to create a CBDC and might need further authorization from Congress.
Hi, Julia. Crypto wasn't even developed by central banks. It was developed from the ground up. Stablecoins, a part of the crypto ecosystem, that was developed basically from the ground up. Why not let stablecoins do their job and innovate and do whatever? I mean, Tether, for all its faults, won't spy on me, when I do transactions, as far as I know. So why do we need CBDCs? Why can't we just let stablecoins do things?
There are a bunch of questions out there, and I think what we would argue is that there is an ecosystem that allows for stable coins and for central bank digital currencies to work in parallel. Now, from our research, we see that countries are interested in deploying CBDCs for a variety of reasons. In the Bahamas, it's for financial inclusion after natural disasters with thousands of islands, getting instantaneous payments from the central government to individuals at lightning speed. Other countries are frankly concerned that stable coins or other crypto can affect monetary policy. And that's in countries like Sweden, which manage autonomous currencies that are tightly pegged to the euro. So, there are questions about how this will affect broader monetary policy. In the US, the consensus, and I think what the testimony shows is there isn't quite consensus, and there certainly is a lot of political disagreement across the aisle about how to manage this. Is that we can potentially reduce the speed of transaction significantly. It takes sometimes days to conduct an interbank transfer and a week to conduct an international interbank transfer. So CBDCs can offer an instantaneous remedy to that. The other thing that we think is really the most effective use of a CBDC as opposed to a stablecoin is in relationship between the federal government when it is issuing direct payments, stimulus payments, particular federal aid programs to the individual. It's hard within our regulatory environment to see that being effectuated by a private service provider.
Hi, Julia. Welcome to the show. I tend to agree with you that I don't see why CBDCs and stablecoins can't coexist, and I also don't see why the U.S. should just kind of further develop this. But one question that I've actually never seen addressed is how much would it actually cost the U.S. to develop a CBDC, right? Because some people are like, okay, well, just try it out, just see if it works. But I'm not clear about how much this would cost the U.S. government to do.
I can't tell you that either. I mean, whether it's in men and women power or in the investment in technology, we haven't necessarily seen estimates either. And that's actually a nice hint for us as we expand our tracker. Maybe we should start making estimates on that based on what other countries have experienced. First and foremost, it's a question of what the Bank of International Settlements, the time and research, just basic research power and the cost of that to design and implement a CBDC. And then there's the time it will take to pass necessarily regulation and what regulators with the SEC and the Treasury Department are going to have to put into this. And then how we're going to partner with the private sector. I think we understand there's a misconception out there in the United States that a CBDC is going to operate in a vacuum between the Federal Reserve and the federal government, and there's going to be no role for the private sector there. In fact, we see it as the opposite. We think, based on the tracker and the experiences of other countries, there are a couple who tried to do this without using financial sector intermediaries, and they realized they couldn't do it. It was way too much of a burden. They didn't have the customer interface. They didn't have the infrastructure. So for the rollout of something in the United States, we're going to have to work closely with U.S. financial institutions. And so that's also a private sector cost that we'll have to face.
Julie, can you just put into very simple terms for people who don't follow this closely, what is the worst that could happen if the U.S. falls behind? I mean, is it losing the dollar status as the global reserve currency? If you could just put this in the simplest language possible, what really does the U.S. have to lose here?
Over longer term, then there will be threats to the U.S. as a reserve currency. As we testified earlier this week, we were trying to tap down concerns that this was coming in the near future. Given the depth and breadth of U.S. financial markets, as we all know, this isn't nearly in the offing. But what we see is, because so many countries are moving forward with this so fast, is the risk of a fractured financial sector and international movement of money, and that countries that don't necessarily share our interests in privacy or in data protection or in quite frankly in monetary stability are going to perhaps build models and proliferate models that do not serve the U.S. interest. So that's part of the reason why we're trying to light the fire under actors in Congress. It doesn't mean that you have to launch a U.S. CBDC. We just have to use our regulatory power and our position in the global financial system and in the G20 to help issue in standards that are reflective of the Bretton Woods system and the commercial banking system as we currently have it. And that is, I think, our strongest argument for U.S. involvement here. Obviously, we don't see it happening. China's internationalization of a digital yuan is in absolute baby stages. But there is, if we don't move forward and try to show a model for this for the international community, which is, by the way, asking us for it, then over time there is a risk, a significant risk, that actors like China are going to be able to make their model very appealing. And that's not in the interest of U.S. consumers or the U.S. government.
Julia, we have sizable portions of the global population who won't even take a vaccine to save their own lives. What makes you think they'll adopt the central bank digital currency?
That's a good question, a good point. And I think that there's the communication that we can use is to say, look, this is going to get you your money at lightning speed. If you have a rent turnaround, it's not going to take days and you're going to worry that a check is bouncing. You're not going to have to worry that about international, about bank codes and other nitty-gritty stuff that when you have you're in dire financial straits, quite frankly, and is not going to be the first and forefront in your mind. Plus, we have to think about a large percentage of the U.S. population, relatively large, given what the United States is, that remains unbanked due to their risk profile. So taking all that into account, we could prove the efficiency of a CBDC as a payment system. But you're right to point out that there could be a suspicion of a central authority issuing payments. But as we saw coming out of the distribution of the CARES Act, for example, that many people who needed the money didn't get it for weeks or months. Right. And that's a significant argument.
We have to wrap up, but I just want to ask you one quick last question. You mentioned that if the U.S. doesn't act, other countries will define standards like privacy, like cybersecurity. China is on the forefront of CBDCs. They have controllable anonymity in their current currency. And so I just wanted to ask, how private is their digital yuan?
I think it's safe to say that based on standards that we would say private, not private at all, and that it is designed to provide access by the state to the payments of Chinese citizens.
All right, Julia, appreciate your time. Thank you so much for your in-depth research and analysis.
Thanks so much.
That was Atlantic Council Senior Fellow and Deputy Director Julia Friedlander. That's it for First Mover. Thank you, Emily Parker and Lawrence Lewitinn. I'm your host, Christine Lee. Coming up at noon is The Hash. You're watching CoinDesk TV.